Good afternoon. Thanks for tuning in. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. I'm Navneet Saluja. These are the top headlines at this hour. Markets are set to end the week on a high note. The Nifty trades around the 11,800 mark. Most sectoral indices are trading with gains. The PSU Banking Index is the top sectoral gainer in today's session. All constituents of the index are also trading with gains. IT stocks are bucking the trend on the index as the rupee continues to appreciate. And Jsw Steel is trading with gains ahead of its fourth quarter numbers. The company may report weak set of numbers. Good afternoon, Neeraj. Well, the buying momentum continues. We've now crossed the 11,800 mark as well in today's session.
Yeah, and the banks really ripping the course. And Navneet, today about a couple of percentage points higher, and I'm sure we'll talk about that. All that's happening in the large cap arena, mid cap arena, and the derivatives arena as well. But start off with what the Nifty Bank is doing, 600 points higher in trade. And remember, yesterday we were talking that was a bit of a profit booking session because there had been a sparkling rally in the anticipation. So a bit of profit booking that happened, but FIs put in the money. Today's move seemed to suggest that could well be the case again. Banks moving up is a fair replica, but it's a good solid session for the banking space. And then the heat map will show you what's happening within the index too. All marketing companies would be somewhere in the gainers list. Autos and rate sensitives are there. I must tell you, all marketing companies have actually gone off from being the top 10 gainers. None of the top 10 gainers have OMCs. BPCL is right here, 2.5% higher, but not in the top 10 list. So autos with Mahindra & Mahindra, Tata Motors and Eicher Motors and Hero MotoCorp bouncing back. Some bit of gains in banks like SBI and ICICI Bank. Larsen & Toubro was amongst the top recommendations on the election verdict day. Yesterday came a bit back. I mean, on the election verdict it came back, but in today's session up about 4%. So strong show out there as well. I remember Mahana Chopra speaking about it. What's not done well? IT again pulling back a little bit, and you don't quite see Reliance in the top 20 list, so keep that at the back of your mind. The big boy isn't quite performing in the session today. It's lying absolutely flat amongst the top 10 losers, but absolutely flat essentially. So that's what's happening on the index. I reckon the turnover is the first day of the new series, might not be that high as well, but Devina, that is one thing, which is the turnover. The other thing is how the broader markets have done too.
Yeah, the first day of the new weekly series, if you go to see after yesterday's weekly close, it's still on the higher end compared to what we were seeing a few days prior to the actual Thursday trade. So 7.3 is not a bad number to start off with. Cash market, yeah, the cash market too is at a healthy. We still have 1.5 hours to go. So this is not a bad number actually. 29,500 odd crores. But for the broader market space, I just want to quickly highlight what's been happening there. So there is a pickup nonetheless. So within the mid caps and the small cap pocket, remember a lot of market commentary suddenly shifting focus on how there are extremely good value buys in some of these smaller companies, but companies which are not very leveraged. That's the commentary that's shifting towards mid caps and small caps, considering they're trading at a deep discount to some of the other bigger Nifty 50 stocks which are trading with stretched valuations. Taking a look at today's move, 1.35% of the Nifty Mid Cap 100 index, and the gains coming in the form of Bharat Electronics up about 7.8%. JSW Energy, Bank of India, Manappuram Finance, Union Bank of India. So these mid-cap PSU banks are taking charge in today's session. Remember, another favorite now suddenly that has propped up has been the PSU banks. Consolidation, the fact that they've already seen aggressive provisioning happening, all of these things could actually propel growth for them at a much faster pace according to most market commentary. Amongst the losers, Emphasis falls about 5% in intraday trade. You've got Sun TV. Remember, Emphasis not yet reported numbers. We will see the numbers coming out soon. Sun TV is the other one. On the back of numbers is doing not all that well. Bata reports numbers, that's down about 2%. And then you've got the likes of an RBL Bank, which is down 1.5%. Within the small cap space, just to highlight what's buzzing about, a 10% move on India Cements, and Delta Corp comes back into the fore. 10% higher for Delta Corp this afternoon. Ashoka Buildcon, that's up about 6.8%. Psu Solutions, 6.5% higher. And some housing finance companies are doing well. What's not doing well there is Just Dial, which is down about 8.5%. Remember, very heavily owned by the FIIs. So that stock in today's session is down under. The excitement around the Hinduja Brothers' potential bid for Jet Airways fizzles out today. Is down about 3.5%. PVR looks weak on a day where Inox is actually done well. So Inox in early morning trade was up about 8%. And the other one that I want to highlight is an Ashoka will report numbers post-market hours, but before that, ahead of numbers, the stock's up about 6.5%. But that's what the the broader market space is doing. What's happening in the derivative space, Navneet's going to highlight that for us.
Thanks for that, Davina. Well, on the derivative side, if you look at the positioning, I think on the futures side, there is more interest seen on the bank Nifty, and that's been the case as you highlighted that the PSU banking lot has been doing pretty well since the time this rally started. So if you look at the open interest, there is built up on bank Nifty futures, though on Nifty it's 5%. But if you compare the total OI to the start of the series, we've not seen any gains coming by. 15% higher when it comes to Bank Nifty futures, indicating maybe some long positions are definitely being taken. Bank Nifty is trading with gains of over 2% as we speak. And volatility index has collapsed for the second straight day, but it was expected post an important event. So today it's down 15%, 16.5 is the level. What range one can watch out for? Until now, the short-term range that the technical analysts were highlighting was between 11,600 to 11,800. We've already surpassed the level of 11,800. The open interest distribution on your screen, the maximum open interest on the call side is at the 12,000 strike, and on the put side now it is at 11,500 followed by 11,700. Interesting trend, when we crossed the 11,800 mark, there was unwinding seen on the 12,000 call, which is telling you maybe the traders who had written that strike are running for cover. So there's some unwinding seen of nearly 3 to 4 lakh shares, and writing coming in on the 11,700 put, where premium is somewhere about 45 to 50 rupees. That's giving you a support for this market now, coming in at 11,650. In terms of stock futures, Bharat Electronics is one of your top F&O gainers for the day. In fact, the stock's gone up on high volumes on the cash side as well, 18% higher when it comes to the open interest build up, fresh long positions. The white line is projecting today's volume vis-a-vis the average volumes which was seen in last 20 sessions. That's the blue line. So looks like there is some cash-based buying and also action seen on the futures side. India Cement is the other one. The numbers come out tomorrow, so watch out for this. The stock's already up 15 to 16% for the week, out of which it's up 10% in today's session. So long build-up seen on the futures side. Manappuram Finance, the stock's hit its all-time high levels today. There is some build-up seen on the long side. The counter has been doing pretty well post its earnings. Last week it was up 5%, and now this week it's up almost 12 to 13%. On the downside, Bata India, this is a counter which will be coming out with the numbers today. There's a lot of open interest build-up seen of 22 to 23%, though the stock's only down 1.5%. Maybe ahead of the numbers, traders are taking bets on this one. So watch out for Bata India.
Okay, let's begin with the market voice. Ajay Bagga of OPC Asset Solutions joins us right now on the show. Ajay, good having you. Thanks much for joining in. The back to business, which everybody spoke about, is looking very strong in the session today. Yesterday may have been a day of profit booking, but the back to business today suggesting 2.5% for the Nifty Bank, 1.5% for the Nifty 50. We may be expensive, but we're seeing flows.
Yeah, definitely. And, today I did see some amount of basket buying coming in, the way there was a coordinated rise in the market. Obviously, there are fresh funds being placed, Neeraj. We have seen this week, 4 out of 5 days, a positive FI flow. And domestics, even though the number was negative, but our talk to mutual fund managers is showing that people are either invested over this week or are planning to invest out now. So a big overhang on the markets has cleared, and we would say time to take fresh positions with a 1 year, 2 year, 3 year perspective. We are expecting mid caps, small caps to rally much faster than the larger market, but still quality stocks, even in the large cap, will have their time in the day. So it's a good time to now ponder over your allocations and allocate fresh funds into the Indian market.
Okay, Ajay, so let's talk about this practically. A lot of pockets which are probably going to show growth are looking expensive. If it's a good time to put money to work, where does one do that? Financials very expensive, autos not expensive, but the growth is unclear. IT out of favor completely. That's three large buckets, not quite looking certain. What does one do?
Yeah. Yeah, good point. I would say the top picks stay financials. Within financials, private sector owned corporate banks, they will be the outperformers. Second is public sector banks might be now starting a cycle finally. Remember, public sector banks have gone down from 27 to 19. We are expecting over the next 2 to 3 years the public sector bank mergers to take place, and 5 or 6 good scale banks will emerge. So it might be a good time to buy the top 3, top 4 public sector banks. That's a turnaround story. Finally, its time is arriving. Retail focused private sector banks will continue to do well, not cheap, but extremely well run, extremely offering a lot of growth potential. So we would still invest in them. The other sector, what you mentioned, I agree, auto. Auto is coming off a pretty mediocre quarter last quarter, and this quarter also won't be very great, but we see a turnaround coming. As the liquidity issue in the market gets addressed, post the budget, we are expecting some kind of a pickup in auto. They have taken a lot of remedial measures. The production has been reduced, and we are expecting auto to turn around over the next 2 to 3 quarters. Back to it should come back to growth days, and then the base effect will start coming in on a 1-year basis from January of next year. That will also help auto. So auto can be looked at. Cement is looking very interesting. Already we have seen fairly okay results for the last quarter. Post that, April and May have seen good pricing increases. Operating leverage is very strong in cement, and it will be a beneficiary of all the infrastructure thrust that is expected from the government starting next week and then going into the July budget. So cement is another sector that can be looked at. IT has its fair share of problems, but we don't expect the dollar to weaken too much. We don't expect the rupee to appreciate very strongly. That will be positive for IT. But the slowing global economy remains an overhang. So we would be neutral on IT, but select top-end IT. I would still recommend that on a longer term basis, you can be a holder in those. Those will tend to do well.
Ajay, you've highlighted a couple of sectors, but if one were to look at the stocks within those sectors, would you opt for the larger cap ones or the mid cap stocks? Because the broader markets, if you look at the returns last year, they were down. However, you've seen the benchmark indices trading around their all-time high levels. Do you think the risk reward could be favorable in the mid cap stocks?
Yeah, definitely. I think, and we have seen that historically, as the economy starts accelerating, as more stimulus comes into the economy, the small cap, mid caps tend to outperform. And I would again say you can't take a sector view on small cap, mid caps. It has to be very stock specific, which I'm constrained from giving names. But the themes that one can look at are good quality stocks with good cash flows, strong management, strong track records, which have got beaten down. There are enough and more of those over the last 2 years, especially 2018. Second half, we saw very sharp correction in mid and small caps. I think those kind of stocks are again seeing a lot of traction, and they will outperform. Having said that, large cap quality is evergreen. So I would say 30-35% in large cap and 65% in mid and small cap. That's how an average portfolio can be structured. But definitely rest of this year and the next 2 years look like mid cap years. Unless mid caps run off very sharply this year itself, then we will revisit our views by January. But the next couple of quarters, we see mid caps outperforming.
Ajay, there's a lot of talk, related to the infra and the realty pack, and especially after we've got a decisive mandate coming by, companies would be expecting order wins now, and also this was the government who put a lot of thrust on affordable housing for everyone by 2022. Last time when this theme came into the picture, we did see stocks rallying, but that rally had fizzled out just a few months later. Do you see an investment opportunity here, considering now for the second term we've got a government which has full majority?
Yeah, and they're talking of 10 trillion rupees of investments in infra. That's going to help all these companies. So I would say real estate turnaround is coming. It will take some more time because this time around the price correction has not been allowed because of the very high ready reckoner rates that all state governments have put in their greed for higher stamp duty. So earlier what used to happen, the ready reckoner rates used to be very historical rates, much lower than the market rates. And you could see 20-30% kind of cuts coming. The market would correct out the real estate cycle and then help out new investments to come in. This time that has not happened. So you have a lot of inventory. You don't have too many new projects being announced, but at least 4 to 5 very well capitalized real estate companies, both in the west and the south of India. I think they are looking good. The North India large real estate company is doing a lot of restructuring of its balance sheet that has started to pay dividends. So overall, the survivors, the listed survivors at the top end are looking good. And I think over a 1 to 2 year period, they will give good returns. They can be looked at positively. Infra, yes, it's coming back. Capital goods, definitely. You would have seen the Cummins results, Thermax kind of results. The Siemens results, ABB results. What they are all pointing out is that the capital goods recovery is imminent. We hope that something is given in the budget towards private capex, which has been languishing for the last 5 to 6 years. That is a crying need now. But even without that, the infra spend of the government will see these infra executors doing well. And the second way to play it will be cement. Cement will be like a universal theme, and which will do well. Lot of operating leverage in the cement players, both mid-cap as well as the large-cap players. Those can be looked at.
Ajay, I heard you briefly mentioning the PSU banks. Now, several factors that have played out. We're talking about consolidation. We're talking about aggressive provisioning, which has already been undertaken by most of them. We're talking about some recoveries via IBC. So there are various moving parts affecting this particular pocket as a whole, which could probably determine the future fortunes within this pocket. Do you actually see this being as incrementally positive as it's made out to be?
Yeah, it is turning, it's been 11 years of no performance by the PSU banks, but they have a huge market share. They're getting their act together finally. A lot of the banks coming out of PCA. Mergers have happened, more will get announced. Government will front end it into the first part of its tenure. The second part is there was no mention of capitalization for this year in the interim budget. We are expecting an allocation to come in, which will be positive for these banks. It will open up capacities for further lending. NPA issue has plateaued. You will have those one-off accidents like ILFS, like Jet, which will have to be taken in. But largely the big loans have got provisions, have been put under NCLT, IBC, and those will keep on getting resolved either ways with some haircuts. But the big thing is the flow of NPAs has subdued substantially. That will help these banks because now the operating cash flows will start coming into capitalizing them further, and with the mergers there will be a lot of cost synergies. The big merger of Bank of Baroda, there's talk of 900 branches being merged. That will help real estate costs, IT costs, all the other concomitant costs. Nobody loses their jobs, but a lot of synergies will come in. ATMs will get merged in. All these will help the cost ratios. On the revenue side, we are seeing the green shoots on the credit revival. I think the budget and the RBI policy of June 6th will bring in some more green shoots on that end. We are expecting a rate cut on June 6th. That will help treasury gains. So a lot of positives going for PSU banks after a lot of time. Is it factored in? Largely, yes. Largely, the market has factored in most of them. What I'm expecting is the announcement of further capitalization, the rate cut actual impact coming in, and this quarter's numbers, when they come in by July end, that will see some kind of further fillip to the PSU banks. So the top 4 or 5 PSU banks are a buy in my book.
Okay, Ajay, we'll leave it at that note. I appreciate you joining us today and taking us through your thoughts on the markets. And as we speak, markets are at days high, 11,830, almost 170 points higher for the index. And stocks like Tata Motors and M&M are your top gainers on Nifty. Some incremental buying has come in on both those stocks. Tata Motors is up nearly 4% in trade as we speak, and M&M too seeing good amount of gains. All right, let's shift focus to earnings then. Ashoka Buildcon reported good set of numbers. In fact, if you look at the revenues, the top line was up almost 80% on back of better execution of order backlog. What led to this sort of operational performance during the quarter gone by? Let's ask the CFO of the company, Mr. Paresh Mehta, who joins us on the phone line. Hi Paresh, good afternoon, and thanks a lot for joining us today on Bloomberg Quint. Congratulations, by the way, on good set of numbers. We've seen a healthy growth operationally, top line. I believe your bottom line was impacted, though it was above what the street was expecting because of high tax rate. First, tell us, take us through the highlights of the quarter. What led to margin expansion this time around to almost 13.8%?
So, good afternoon. On the background of a very robust balance order book of almost 10,000 crores, this quarter has shown a robust revenue of, so from that perspective, almost a revenue of 1,200 crores for this quarter on the EPC side. So, and an overall revenue of 1340 crores. So, giving a 76% fillip in the revenue side. This is basically driven by our 3 major HAM projects in Punjab, Gujarat and Andhra, where they have contributed substantial to the revenue. And this order book which we have closed is almost 9,500 crores, will continue to drive the order book for the following year also.
Your bottom line, Paresh, has been impacted because of higher tax, and of course finance cost also remains on the higher side. Will the tax rate of 35% continue, or do you see that rationalizing going into FY20?
So this will rationalize to whatever the regular tax of 34% is there in the coming year. Last quarter, there are certain previous year tax provisions which were accounted for in this, which was partly provided in the past year, so fully provided as per the return. So that is one of the impacts. Interest cost typically is offset by interest earned on the revenue side of almost 40 crores, which is intercompany loans. So from that perspective, interest cost will set off as on a standalone basis. So the revenues definitely revenues look up, but margins will in the coming quarters will definitely look better.
You said your interest costs set off because of intercompany loans, but I think on consolidated basis as well, your
also it would, yeah. So,
your finance cost has nearly doubled on year-on-year basis.
Yeah, this is because execution has been substantially high, one, and then we have also invested in the HAM projects, which will where the equity has been infused of almost 300 odd crores in 18-19. So from that perspective, the interest cost is high. It would stabilize in the coming 2 years once the profits are earned from these projects. Then there will be a plowback of profits.
Okay. Paresh, I believe you impaired some amount of nearly 47 crore towards GVK. There was also some hearing, I think, in the past quarter. What's the total outstanding arbitration claims which are still there, which one could see in the subsequent quarters?
So, on the provision side, we had financial and operational creditors with one of the Chennai-based GVR Infra, who is under NCLT. So total exposure was 60 crores, of which we have already provided 48 crores. So that is one part of the impairment of our receivables. Apart from that, we have almost 1,400 crores of arbitration claims, of which almost 650, 700 crores were won in this year. So these arbitration claims would fructify into cash coming in over the period of time.
Okay. I'm just moving away from your earnings now. We've got a decisive mandate. There's a lot of expectation that there'll be a lot more order flow coming by. What is your estimate? What sort of order flow do you see coming in FY20?
With the new government in place and the same government in place, definitely their focus will continue to be on highways and roads. And we expect that order flow would now begin strongly, which was slightly subdued in the last 2 quarters of FY19. So we expect approximately 3,500 to 4,000 crores of road projects to be won in this year, and some around 2,000 crores in the power and the railway sector. So that's what we expect to garner.
Okay, Paresh, we'll leave it at that note. Thanks a lot for joining us and taking us through your quarterly performance, and all the best to you for FY20. Well, that's the management of Ashoka Buildcon. The stocks moved up. The numbers look pretty good, guys. And I guess on the bottom line front, the figure was there was a degrowth because of higher finance cost. Depreciation cost was also on the higher side, and tax rate, as he mentioned, was somewhere about 34 to 35%. But overall, the numbers definitely looked good.
All right, and the stocks reacting to those numbers, about 5.5% higher. Volumes have also picked up, 128 on the stock. On to a Bloomberg Quint exclusive. Jet Airways' White Knight is not willing to step in without getting some concessions from the lender. Sources tells Bloomberg Quint that the Hinduja brothers want a haircut on the amount due to banks. Vishwanathan Nair joins in to get us this exclusive. 80% haircut, I believe. That's the figure, Vishy.
Sources are telling Bloomberg Quint that at this point in time, a discussion between the Hinduja Group as well as lenders to Jet Airways is not really going anywhere, with the Hinduja Group being currently tentative in its approach towards acquiring Jet Airways. What we understand from our sources is that these discussions are currently only in the preliminary stages, that is on the exploratory phase. And if a plan were to come out, then Hinduja Group will seek at least an 80% haircut on Jet's debt liabilities, as well as taking over only a minority stake in the airline. Now, what we understand is that bankers are unlikely to approve this resolution plan, because they will end up with some portion of the equity left on their own books, for which they will have to look for investors later, and a large write-off in the Jet Airways case, which either of these things are not acceptable to the lenders. Now, currently, the conversations are still ongoing and nothing is final yet. But if the resolution plan were to fall apart, then the lenders are considering to take Jet Airways to the NCLT for liquidation proceedings. If that happens, then the eventual recovery for the lenders to Jet Airways would be quite minimal. Now, remember that Jet Airways was grounded on the 17th of April, and it has been losing value ever since. It has already lost out on a lot of routes as well as slots at the airports, while some of its planes have already been given to other airlines, so that the domestic traffic needs can be met with. Without planes and without any routes or slots, it is unlikely that an investor will come into Jet Airways and turn around the airline, because there's really not much left. Now, lenders still have to take a call, and it is likely that by the end of next week, we will have a clearer idea whether Hinduja Group is actually coming in to turn around the airline, or if lenders will be forced to take it to the NCLT.
All right, Vishy, thanks a lot for that. Those are Jet Airways. Those are some exclusive details coming about with the kind of bidding that the Hinduja brothers want to do with the haircut that they are asking the lenders to take. The stock, though, has come off from those highs of 165 that it recently touched. It's at 148. The other stock in focus is going to be Jsw Steel as it reports its Q4 numbers. Expectations are not running really high in terms of what they're going to post. They're expecting a net profit decline of 48.3% this time around, to come in closer to 1,486 odd crores on a very subdued revenue growth of just 3.3 odd percent. 21,508 is what you're expecting in terms of the revenue growth. EBITDA margins are expected to slip a little bit more, 20% versus the original 25.4% same quarter last year. We got the EBITDA also shrinking by 18.5%. Remember, segmental breakup, according to Motilal Oswal, you're seeing almost a 64% dip in the JSW coated segment, with the US mill segment seeing a dip of 48%. Raw material prices, two of them, one being iron ore prices, that would have aided on the more positive side, but that is being offset by the higher coking coal cost that could offset the benefits of the lower iron ore cost. However, lower steel prices as a whole is the reason why you're expecting the EBITDA to shrink by about 18.5%. What else to watch out for from JSW Steel's Q4 performance? The performance of its overseas subsidiaries and the overall demand and commodity price outlook that has been projected. Remember, it's a very cyclical space, so you're going to be watching out closely for what the global picture pans out with regards to the steel industry as a whole. So a better idea in terms of the demand and pricing scenario is something that you can get out of the management commentary. That's JSW Steel ahead of numbers, 2.8% higher. Let's bring in our guest then, Brijesh Singh of Stock Access. He's joining us right now on the show. Along with him, Ruchit Jain will be joining us in just a few moments. But Brijesh, let's start off with you. Today's day has not been bad. 11,822, good solid 165 points on the index. What would the trade look like?
Good afternoon, Devina. See, no doubt, first there had been a huge volatility in the indices. Nifty, after making a high, a previous 52-week high of 11,856, getting corrected to the level of 11,106 or 108, and after that we have seen a V-shaped sort of recovery and making a 52-week high or all-time high of 12,040, and then again getting corrected. Even if we look out the chart on a shorter term time frame, the 19th was the exit pole, and the 20th we have seen a gap up opening, and the second gap up opening was on 23rd. So the first on the 23rd gap up opening has been filled, but still that 20th gap up opening has not been filled. So there would be a probability in coming days that Nifty might try to fill that gap, but as a theoretical book, what we read in technicals analysis, like whenever the gap has been formed, it takes 2 to 4 days. Now the modern theory says that it might be not 2 to 4 days, it might take another say 7 to 10 days. But right now what I'm looking for a very short term time frame, keeping a 1 to 2 day strategy for a Nifty spot. Anything below 11,800, one can take a buy call on it with the strict stop loss of 11,750 and play for the target of 11,885. Even the target can be extended to the level of 11,920.
Okay. Brijesh, what are your stock ideas for the day?
No doubt we have seen a buying coming in a tire sector, so that C8 is looking good. The high lows formation on the price chart on a shorter term time forward with the oscillators is giving a buy call. So when I have recommended to you, it was been trading somewhere 1,020. If I'm not mistaken, right now it has been trading somewhere in 1,030 or say 33. So if it trades somewhere below 1,020, one can take a buy call with the stop loss of 990 and play for the target of 1,075 to 1,080. Time frame to hold would be a 2 to 3 trading session. And another buy call is a Raymond. The Bollinger Band breakout has been witnesses in a daily chart, followed by the high lows formation, the oscillator, which is giving a bullish view. Somewhere around 845, the stock has been trading. Anything below that can be used for a buying purpose with the strict stop loss of 820. Play for the target of 880. Time frame to hold this would be 1 to 2 trading session.
Okay, watch out for Raymond as well in the session today. Well, Ruchit Jain is with us too. Ruchit, thanks much for taking the time. Good afternoon. What's the call on the Nifty Bank, Ruchit? 627 points higher.
Yeah, very good afternoon, Neeraj. Neeraj, if you look at the recent volatility which has seen in the market, I think 31,200 to 30,200. This is a broad 1,000-point range in which the market has traded in this recently last 3-4 trading sessions. Yesterday it didn't went above that, but it was only for first initial hour that it went towards 31,600, then and again corrected sharply then. Now if we see the price, the index has already moved from the lower levels in today's trading session. If I look at some of the options data in Bank Nifty index, then 31,400 call option, 31,500 call option, these two call options have very good open interest built up, which indicates that the writers who have written these call options are still active over there. So unless we see some short covering coming from 31,400 call options on the higher side, the risk reward ratio now is not favorable to create any fresh long positions here, because although the VIX has reduced, but I think within the range we could see some decent volatile moves on the indexes front. The broader trend is positive, but after 600 points already up move today, I think one should avoid taking any kind of fresh trade in the Bank Nifty index at current levels. If any existing long positions are there, then keep a stop loss below 30,730 and continue to hold that.
Okay, Ruchit, in terms of individual stock bets this afternoon, what are you recommending?
Yeah, so one of the call option is one of the recommendation is from the PSU space. We have seen very good volume flows in last couple of trading sessions in many of the PSU names. Engineers India has seen a consolidation phase of about almost 6 months now, and the way the volumes have increased in last couple of days from the lower level, it indicates that we may see a trended up move in Engineers India in near term. So one can go long in Engineers India with stop below 115, expecting short term target around 127. And we have seen a good momentum along with price in most of the sugar names today. So Dhampur Sugar is one of them which has given a breakout from a consolidation phase of almost 4 months in today's session, and the breakout has also been supported by very high volume. So we are expecting a good follow-up momentum in this. Dhampur Sugar could be bought for a short-term perspective with stop below 207. We expect the earlier all-time highs of around 255 to be tested again.
8% higher for Dhampur. In fact, the entire space is buzzing. Look at something like Awadh Sugar. The entire sugar pack is up, but I guess there are some reports indicating that UK Prime Minister Theresa May just announced her resignation. She may step down. Let's cut across to the Bloomberg network, where British Prime Minister Theresa May is addressing the media right now.
Be reached if those on all sides of the debate are willing to compromise. For many years, the great humanitarian Sir Nicholas Winton, who saved the lives of hundreds of children by arranging their evacuation from Nazi-occupied Czechoslovakia through the Kinder transport, was my constituent in Maidenhead. At another time of political controversy, a few years before his death, he took me to one side at a local event and gave me a piece of advice. He said, "Never forget that compromise is not a dirty word. Life depends on compromise." He was right. As we strive to find the compromises we need in our politics, whether to deliver Brexit or to restore devolved government in Northern Ireland, we must remember what brought us here. Because the referendum was not just a call to leave the EU, but for profound change in our country. A call to make the United Kingdom a country that truly works for everyone. I'm proud of the progress we have made over the last 3 years. We have completed the work that David Cameron and George Osborne started. The deficit is almost eliminated. Our national debt is falling, and we are bringing an end to austerity. My focus has been on ensuring that the good jobs of the future will be created in communities across the whole country, not just in London and the South East, through our modern industrial strategy.
Okay, that's the UK Prime Minister Theresa May addressing the media, stating that she may step down on June 7th. Let's just do a check for the European market indices right now. I think majority of them have been trading with gains. Remember, yesterday it was a carnage across Europe. Right now, FTSE is trading with gains of 0.7%. CAC and DAX also seeing gains of nearly 1%. And back home, we're having a good session. Nifty is up about 168 points in trade, and we were addressing the sugar space. The entire sugar pack is up and about. You look at stocks like Mavana Sugar, Awadh Sugar. Ruchit had a call on Dhampur Sugar, which is doing well. Uttam Sugar has also seen gains of nearly 17 to 18%. So the entire space has been buzzing. The other stock which has gone up in trade is Jsw Irrigation. So pull up that stock. It's trading with gains of nearly 8 to 9% as we speak. It's at day's high. Ruchit, if I could come back to you on Jsw Irrigation, which has seen gains of nearly 8 to 8.5%. Would you take any trade here?
Not really, because if we look at this Jsw Irrigation, since last 1.5 years, it has continuously formed a low top, low bottom structure. Now, today is a day when many of the mid cap and the small cap names, and especially the beaten down names, have shown a pullback move. And I would take this just as a pullback move within a downtrend. So unless we see either a high top, high bottom structure or the resistance of around 61 getting crossed, I think one should avoid any kind of bottom fishing in Jsw Irrigation even at current levels.
Oh, that. All right. Heidelberg numbers there on your screen. So profits has gone up by about 17% odd. Revenue growth slightly more muted, about 2.5% odd revenue growth has come in. EBITDA has seen a 4% increment. The stock though has cooled off from the highs of the day. 202 is where Heidelberg Cement is trading at. But nonetheless, you've seen the entire pocket of buzz with activity, pricing power coming back in. We've seen a fifth straight month, as per our dealer survey, suggesting that it's the fifth straight month where pricing hikes have been taken by cement majors. Whether or not they stick to this or whether or not there are any rollbacks that come in, that goes to be seen. But as of now, they are running at capacities of about 75 to 80%, giving them that edge in terms of increasing pricing power. Richard, just come in on India Cements, if you will, and if you've not already spoken about it, at 113, what would you do with this stock?
See, broadly, the stock has a bit resistance around 115, 116, which was the high registered in the first week of April. So, the stock needs to cross above that 116 levels now to show any kind of continuation of this momentum. Yes, if we look at the overall cement space, then the broader trend for this entire sector is positive. But the only thing is that in last 4-5 trading sessions, we have already seen an up move in India Cements from levels of around 92, 93 to 114, 115 now. So, one should either wait for a pullback move again towards 104, 105, so that the risk reward ratio would become favorable, or let there be a breakout above 116, which would again confirm a continuation of a follow-up move of the recent up move.
That's India Cements there for you. Many more stocks to talk about. Delta Corp being one, which is up about 10% odd at 193 now. Last 1 month has been quite bad. Stock's been down about 20% in the last 1 month. But we'll get a chart check going for all of these stocks and more. But in the meantime, let me bring in Rahul Arora of Nirmal Bang Securities. He's joining in the studios with us. Rahul, good afternoon to you. How closely were you glued to your screen yesterday? And what, change of decisions happened as you saw the verdict, or none?
Honestly, wasn't that glued at all.
Yeah.
To be very frank, but I think the exit polls were so one way.
Yeah.
I think the verdict was pretty well. I mean, if there was a discrepancy in the exit polls, it would have been a little more interesting. But I think by the time we knew what was going on and people had their morning cup of coffee, the
the surprising part was that, at how early in the day everyone started to build in the clean sweep victory. I mean, while we anticipated it to be a slightly longer day in terms of counting because of the different methods of counting, but it happened pretty early in the day.
It happened early in the day, but what happened wasn't just something that happened in a day.
Yeah.
I think, we've sort of been thinking a lot of, I actually spent a lot of time last night just sort of doing a psychological analysis of what could have been, and I think people living in urban and metro one cities are so disconnected from reality. I sort of get the feeling that, there is a totally different India out there and we just can't relate to it. I think the change that has happened has caught even the most optimistic Modi supporter by surprise, and he's clicking. And, God give him good health, and if he stays that way,
He's clicked for the markets yet.
He's clicked every which way, and, he did a couple of questionable things in his last term. You could have questioned demonetization, you could have questioned the implementation of GST, but now comes the time to reap the fruits. So if he does nothing silly over the next 5 years, our constitution doesn't prevent him from fighting for a third term. He could come back with even a bigger majority than this.
Rahul, I'll just take that point forward. There were some radical measures announced by Modi in the previous term. As you mentioned, the fruits could be reaped. But do you think those measures were right enough that we will be able to reap the benefits in the second term?
Well, the tax base is surely going up. So you can argue to the penny whether the tax collections will come in, but as they say in Hindi, thoda 19-20 ka fark hota hai, but I think eventually he's moving in the right direction. I think this verdict, I was totally wrong in the way I looked at it, and I think instead of people sort of criticizing the mandate or finding excuses, people need to understand what clicked. The man is here to stay. He's done something right.
The vote share went up substantially.
I think to me the biggest headline of this election was probably West Bengal.
Yeah.
I think nothing sort of told you how dominating this one human being is becoming as it did. And he almost took West Bengal from being non-existent 5 years ago. And I think that itself is telling you a story. If he does his work right, I don't see why he can't make inroads into South India by the time he's around for 2024. The only person who can now defeat Modi, and I maintain this since I saw this verdict, is Modi himself. Unless he does something wrong, I think it's going to be very tough to displace him. And good for the country, good for the markets. I think he's taken some very gutsy decisions. People have lived through the pains of it, whether it's SME, whether it's farmers, whether it's, traders. Don't forget, he took on his major constituency. Demonetization basically hit Gujaratis and Marwadis the most, and he almost lost Gujarat. And here he is, after losing 3 state elections back to back in the Hindi heartland, almost losing his home state. So people are now becoming a little more discerning in how they vote in the state and the center.
Yeah.
But I think this man is probably, after this verdict, people should reassess whether they just want to fault the man for nothing. But I think he's probably going to go from strength to strength. And who's to say the market probably won't compound by 15% a year from here over the next 5 years.
Let me guess who you voted for.
Sorry?
So let me guess who you voted for.
Get into that conversation.
You will not be able to.
I think you have to give it to the Indian voter who's become so mature now.
Sorry?
You have to give it to the Indian voter who's become matured, because when you lose, 3 states just 5-6 months back, so the voter voted you out in the state, but they know who to vote for in the center.
Absolutely. And if you look at the state elections, the municipal elections, the bypoll, or the national elections, whether it's gone for the Congress or it's gone for the BJP, there's been a clear-cut mandate. It's not been hung anywhere. There is one party that's got a majority in the state or in the bypolls or in the nationals. So it's definitely the coming of age of a new India, and people should stand up and take note. I mean, things are changing faster than we expected.
Okay, some news bits on your screen. We had the HDFC news before that as well, but we already cut to the network and heard Theresa May. Bloomberg now giving out the official statements. Theresa May says she will step down on June 7th, and of course the new success will need to find the parliamentary consensus on Brexit. So this saga is played out as a few people expected it would, and we have the first of the things happening. Let's wait and watch. In between this whole conversation was also the official statement from HDFC about selling off part stake in Growth Finance, and that stock has certainly taken it in the chin. But banks by and large, Rahul, are doing exceptionally well. Yesterday may have been a day of profit booking. In today's session, it's almost back to usual, and back to usual seems to be some buying by foreign institutional investors.
So, Neeraj, I'm pretty convinced that the upcoming budget, which will probably happen in the next 2 months, though people are betting long on infrastructure for maybe, I think that's probably more a second half of his term phenomena, but I think immediately, because he's got this mandate, it's going to be a very pro-consumption budget, which means anything to do with consumer or banks will continue to do well. So I think that's, when we spoke about 3 weeks back, I said that the FMCG stocks that had fallen between 25 to 50% are approaching a buy zone. I wouldn't fuss too much about valuations from here. God willing, we have a decent monsoon. I think Modi's thrust is going to be to keep that core constituency of his happy. It's going to be a pro-consumption budget, which means banks and staples will continue to do well. You saw that at the high point of the day yesterday. The bank had gone through the roof. Had gone through the roof on Monday after the exit polls also. But I think if FI money has to come in, Neeraj, it's almost 40% of the index. So if you're expecting the market to go up, it can't go up X banks. That's not to say that the market is cheap anymore. At 40,000, which is what we hit yesterday, it was trading at 20 times FY20. So there is that expensive factor. But I think in the foreseeable future, over the next 12 to 15 months, if there are 2 sectors that better, will be banks and consumption.
Yeah, coming from you, consumption doesn't seem a surprise. The question is, what within that pocket has gone out of favor, Rahul? Today we have Page Industries numbers, which might also be a bit off from what the expectations seem to be. A clutch of other names, the same store sales growth, etc., have looked slightly wobbly. What happens there? Do the expensive names find some more money coming in?
So I'll give you a factual and a sort of philosophical answer to this, Neeraj. The fact is, like, if you're talking about companies that are reporting same-store sales growth, even if they're reporting between, say, 5 and 8%, don't forget they're compounding on a 20% plus base. So as far as I'm getting my CAGR, if it's positive on positive and it's compounding in that direction, I'm not too fussed. The other thing that people need to understand is that when these 20% comps came through, they came through on very weak basis also. So I think there is, so from literally here, you went all the way there, and now you're sort of normalizing somewhere in the middle. There is a certain multiplier to inflation. I think, when under Dr. Manmohan Singh, you had 8-10% kind of inflation, you probably needed your SSG to be closer to 15% for the operating leverage to come through. One of the biggest achievements of the NDA has been keeping inflation low. If it stays at sub 5%, I don't think anyone's going to scoff at a steady state 8 to 9% SSG. So that's one part of it. The other is when you are talking about a thrust on consumption, Neeraj, and I would urge you to do this as you interview young people in the age of 20 to 25, you will find that they're not interested in owning cars and houses anymore. They're happy living in rental houses and moving in shared mobility. That is the extent of saving that's going to come in your hand. If somebody doesn't want to spend 3.5 crores buying a 2 BHK in any of the metro or tier 1 cities and doesn't want to spend 15-20 lakhs a car maybe for two, that's where is that money going to go? There's only so much you're going to put into fixed deposits. Even if you're safe, that's going to come in and flood consumption in any which way. On top of that, even if the Congress hypothetically had come to power, they had their own version of consumption boost through the Nyaya program, and so did our current incumbent Prime Minister, who's obviously going to take oath over the weekend again. So I think the staple volume growth, which seemed transient, slowed down. You might be surprised, I think, once the monsoons are over, towards the second half of this year, the ferocity with which it comes back is my sense. I could go wrong. I sort of go with that disclaimer, but I think you probably won't see the volume growth rebound very sharply in the April, May, June quarter because you've had elections and because monsoons will play out. But I think come Diwali and the pickup that you're going to see there after the union budget, which will probably get presented in July, I think could be something special. And I would advise people to go out there and buy leaders, buy the Nestle's, Levers, Britannias of the world. You know, pick one of Jubilant or Westlife, pick one of Inox or PVR, pick one of, you know, V-Guard or Bajaj Electricals or Crompton. Just pick one of these which you think are the leaders. And I'd be very surprised if you're sitting here 5 years hence and these stocks haven't compounded at twice the FD rates on an annual basis.
I think your MNC recommendation has been there since last few years and it's worked well.
Well, it's not just about MNCs, right? And Navneet, I think you're talking about lever, right?
Yeah.
Which is the Drogon of the FMCG market. And he's giving you a 7% volume growth on that base with margin expansion and 150% return on invested capital with 100% return on equity and return on capital employed. And then it's asking you to pay it 45 times.
Okay.
So I think there's another part of the market that's not doing anything.
Yeah, because there is growth street is assigning higher multiples to it. Okay, you said people are going to stop buying cars. What happens to the auto pack, which is already reeling under pressure? Of course, there is one side to it. There is slowdown. The other side is they're moving towards BS6 emission norms, which is going to inflate cost for them. And we've seen the earnings, auto angs which supply to them are not doing great at all.
So I'll tell you a very funny story about the chairman of one of the largest car manufacturers in India, someone Neeraj and I know really well, and I was asking him, you know, sir, what is going on? And how are people looking at this? And he said, Rahul, there's a slightly different way of looking at this. He said, emission norms, rising insurance costs, shared mobility is all fine. He said, my biggest competitor that I am seeing today is the mobile phone. So he says people want to be utilizing their cell phones when they travel, which is why car ownership is actually a very big threat going forward, which is why you find people consuming OTT or checking office emails and doing a lot of that while they're driving. So unless you can afford a driver, you're happy moving to a shared mobility platform, which is actually something that I never thought about. And he said that is increasingly becoming the trend. And I had this conversation with him just a week back, and he was actually giving me the example of his own family member watching pretty much Game of Thrones while he was commuting. So it's a different thought process. I don't know whether the car ownership is going to be such an important thing in the future. See, Navneet, disruption comes through very quickly, and when it comes, it doesn't. 5 years back, there was no Paytm, there was no Swiggy. When these things happen, they come. The naysayers believe it will change, and then they essentially become part of the herd saying, okay, it has changed. That's the rate at which it happens. So I don't think it'll impact the luxury end that much as it'll impact the mass market. I think people that want to go out there and own an Audi or a BMW or a Mercedes or maybe a Harley Davidson or even a Royal Enfield if it's an aspirational bike for them through the Continental or the Interceptor. But I think over a period of time, the industry is undergoing a structural shift. And I don't see, if you see what RC Bhargav has given as his 2022 guidance, it's a 5-6% volume growth. So the question is, what PE multiple do you want to ascribe to a company that's just going to compound at 5-6%? Lever is giving you 7% at bad times. So that's the way I look at it, because as a fund manager or a retail investor, if I have 100 rupees to invest, I'm not married to be investing in one particular sector. If I see cement volume growth at 8-9% and I'm not going to get that in autos with a little bit of operating leverage, why not put my money there? So I think something structurally is changing in that sector. I don't think it's going to come out of the woods as soon as people are expecting it to.
Actually, quite a contrarian view from the conversation that Ramdev had yesterday. He was actually quite big on auto. He said that if you're talking about making this big economy, making India a $5 trillion GDP economy, a lot of engines need to be working at the same time. And people are going to be buying cars. You're not going to see, if your per capita income starts going up, they're not going to refrain from buying cars. They're going to put their money, they're going to upgrade their standard of living.
I don't refute that point of view. He's entitled to have it, and if you see some of his portfolios on the asset management side, they're very large holders, and his asset management is a client of mine. So he's obviously got very large positions in Eicher and Maruti and at one point in time, I think a couple of their funds are holding as much as 9.9% of their funds in these particular stocks. But the point I started this conversation with is. Forget anyone else. I read this election wrong. What did I do wrong when I was reading this election? And I sort of started analyzing that. And sometimes when people have not seen change or disruption to that effect, see, the people going to be driving this country are not people who are my age or above. They are in the age group of 18 to 25. So what do you want to buy from a structural portfolio is what their preferences are going to be over the next 20 years. Where is cars in that priority list? While there is no anecdotal evidence to suggest, but we ask our associates when they want to join us, you'll be surprised that, a lot of candidates that we interview, buying a house and car is not amongst their top 3 things. So obviously some part of consumption is going to boom. What it is, I don't know right now. It could be cell phones, it could be ACs, it could be anything, washing machines, refrigerators, it could be something we don't even know about. So that, to me, sometimes if you can't visualize it, you probably don't understand the extent to which it can change. And having lived through a few disruptions in the last few years, whoever thought Nokia would go out of business? Whoever thought BlackBerry would go out of business? Whoever thought Kodak would go out of business? The list is quite endless. People are now already, I don't know if you've been reading, but some people have been starting to write the obituary of Apple as well. So, there is a time and a place for everything. I'm not saying cars are going to go off the road, but people may find with the metros and shared mobility becoming a big thing that it's probably not as important a thing for them to be doing as it probably was, say, about 5 years back, is the limited point I'm making. Hence, if you're playing consumption, that may not be the absolute best way to play it, even though valuations may be looking extremely attractive to you right now.
Tell you what, a few stocks that have bounced back just before we hit that break. Speaking of consumption, Delta Corp, after getting quite beaten down the last few days, has bounced back 194, 195. That stock is trading 10% higher. India Cements about 11.5. HEG Graphite 12% apiece. So not a bad day for some of these key names. Need to slip into a break. We'll get in some technical comments on the other side. But as we head into the break, hear out some of the top money managers and advisors across and in India and across the globe as they speak about what they would prefer where they would prefer investing after the recent election outcome.
Well, I would prefer to put more money into India and even have a weighting in India that's larger than China, simply because of the growth prospects and the incredible opportunities that we see. Now, of course, this depends on many, many factors. Liquidity, when you look at some of the companies in India, the liquidity is not as good as you'd like, and other factors. But I would say, generally speaking, we'd like to put more money into India.
I think the HFCs are in deeper trouble than the NBFCs. The NBFCs, because their loans are shorter dated, it's car loans, truck loans, consumer durable loans. The loans are shorter dated. I think their problems are less acute than the housing finance companies. Now, even within NBFCs, I think there's one straightforward way to think about which are the ones you should focus on and which are the ones you should run away from. NBFCs have a large corporate house backing them. A Bajaj, a Murugappa, or a Sundaram, a large, credible, high-quality corporate house with strong balance sheet behind NBFC, I think is always a very useful thing to have, because that gives the money market a backstop when they're thinking about buying commercial paper issued by these NBFCs. Secondly, you look for short-dated assets. Look for NBFCs whose asset tenors are no more than, I would say, 2 years. Right? If you have short-dated assets as an NBFC, that's a good thing. You're not taking very long-term credit risk. And third thing, look for NBFCs whose liability tenor has been stretched out. So look for NBFCs whose typical liabilities are longer than a year, ideally 2 years, right? So the shorter the asset liability mismatch, so long dated assets, short dated liabilities, ALM is almost crunched out. That's ideal for an NBFC. And in that construct, Bajaj Finance meets that construct and has been part of our portfolio for some time now. If I had to look beyond Bajaj Finance, I would say the other NBFC which would pass the criteria, we don't have it in our portfolio, but would pass the criteria would be Cholamandalam.
4 aspects of the PSU bank space that need mention. One, consolidation is already underway, and the example of the first consolidation of 3 banks, I think, has been a pretty healthy one. 2, it's come in the backdrop of an aggressive provisioning environment where NPAs have been recognized and written off. 3, the IBC, though slow in the beginning, but I think it's now working its way to actually creating resolution situations. And as non-performing assets get recognized and the balance sheet gets converted to a productive one with redeployment of money, with better risk management, and more importantly with consolidation, I think you're talking about substantial, and I underline the word substantial, change in fortunes for some of the leading PSU banks over the next few years. I think the numbers that they will produce over, let's say, 2019, 20 and 21 will be dramatic, to say the least, compared to, and add very healthy dollops of earnings to the Nifty basket or the index over the next 2-3 years. So I think the big turnaround is going to be in the PSU bank space, already visible. So it's not like I'm disclosing a state secret, but I think that's very visible. Consolidation is very much underway, and I think it will continue. To my mind, a lot of the resolutions have been addressed, taken through the books and moved on.
I think we have to look at overall factors. I think things are fine. It is just that equity valuations are not cheap, except in the PSU area. And in the PSU area, there's a lot of work for government to create an environment where people think that PSUs can deliver shareholder returns. Otherwise, it's going to hurt the government itself, because the value, the residual value of all their investments in PSUs go down. And in the last 5 years, PSUs haven't delivered returns, and there has to be a lot of thinking on the part of government to see what can be done to actually deliver shareholder value even for PSUs, because that improves their residual value and solves their fiscal deficit problem. I think interesting work has to be done in that area as well, maybe through strategic disinvestment of PSUs, large buybacks in the companies which have a lot of cash and low leverage, and various other things. I believe those kind of steps also have to be taken.
As the vote count commences and the markets gyrate